Welcome back to What's on Your Mind. We reach a little bit of a milestone this week with this episode. It's actually the 50th episode that we've aired of What's on Your Mind. And joining me for the occasion are ITPM senior trading mentors Edward Shek and Jason McDonald. Gentlemen, we're certainly in interesting times at the moment. Since markets started paying attention to COVID in late February, the VIX hasn't dropped below 20. Currently, we're on the 16th of September. It's at about 25 or so. It's obviously been much higher in that period. And it's almost as if we've kind of got used to looking at markets with this backdrop, with this backdrop of uncertainty. But that being said, there's rumblings of vaccines on the horizon. There's also elections and things to think about. So I'm interested in hearing from you guys, how that translates to potential ideas and portfolio adjustments. So anyway, gents, great to have you both back. Let's get into it. Jason, why don't you kick things off?
Yeah, thanks, Chris. Hello, everybody. What better way to celebrate a half century than to have myself and Shecky in conversation, guys? Yeah, we'll be pretty brief on the sort of macro market front because, to be honest, at the moment there isn't a great deal to say. As I'm sure most people are aware, we've got the Fed meeting going on this week. We're not really expecting any kind of fireworks out of that. We are obviously expecting for them to maybe elaborate on their inflation targeting strategy, which they announced recently at Jackson Hole. Outside of that, as I say, not really expecting much excitement. Shecky and I were talking about the albeit quite brief market correction that took place a couple of weeks ago now, of literally 2 to 3 days. So we've already had our T-shirts made up that we managed to survive the 2020 September market crash. But talking about that a bit more seriously, we had a relatively rapid sort of at the bottom. I think it was about a 10% correction on Nasdaq, and justifiably now, since we're seeing things kind of grind back, people are asking, well, was that it? Was that the correction that a lot of people have been looking for? Because of course the market had got itself into sort of an overbought situation and was looking a bit frothy, and then of course we had all the options shenanigans with allegedly SoftBank, buying a load of call options and this sort of creating a bit of a melt up during August, and then seeing some backlash off the back of that afterwards. So I noticed today that one of the prominent JP Morgan strategists is actually basically saying, he sees that the correction is done and that the options situation has kind of worked its way through. Me being a slightly old stager and always prone to being slightly miserable, I learned this week that apparently male miserableness peaks at the age of 48. So I'm over the peak of the miserableness. I'm now a year later, I'm 49. So, it's upwards in terms of my general sort of attitude from here, but there's still a part of me which sees the VIX having come down from its highs, but still, if you look at it on a longer term basis, certainly compared to where we've been in the last few years, VIX is still at a relatively elevated level. And I think that with 6 weeks to go until the election, I'm not sure that we don't see some more volatility between now and then. I mean, what are you thinking about that, Shecky?
Yeah, I mean, from a technical perspective, the 2-day, the 10% sell-off got the major indices back onto the long-term trend line. And the market, after a decent sell-off, takes a few days to hold in there. And now we're starting to see a rally. That said, the price action in a lot of the key stocks is pretty uncomfortable. There are periods obviously coming through in the year where if you see Nasdaq futures up 1%, the likelihood is they would finish up 80 basis points or up 1.5%. Now, when you see Nasdaq futures up, it feels that with a bit of bad news, the stocks could unravel quite quickly. A lot of the names that I'm looking at are grinding up a couple of percent or maybe a couple of percent over a week, but it still feels to me like there could be a downdraft at any point. Now, when we have a look at this chart, it's just showing what a V-shaped recovery we really have priced in. when you look at the market levels versus corporate earnings, the glass is very much half full. So there's a huge expectation, in my opinion, for Q3 earnings. They've really got to deliver. Sure, a vaccine comes at some point, regardless of efficacy. Maybe that supports the market a bit more. However, I don't think we can just wait for earnings forever. And as we're still quite close to our long-term trend line, I think it's right to be relatively cautious, have to be properly diversified, try and take out too much sector risk, and just be cautious, position very carefully into earnings. It's hard to buy a lot of the names at the moment, and earnings will be the catalyst, obviously, assuming we get a clear election. Then we could have a rally into year end if, of course, at some point, earnings really have to come to the fore. And that chart shows how the disparity currently between market levels and earnings. So the market is owed some good earnings, that's for sure.
Completely agree with that. And I think also you mentioned there a decisive election result. That is obviously quite important. I don't think there's many people who are actually worried about the election outcome. But
No.
what would be concerned by is any kind of uncertainty over the result, perhaps a challenge or something along those lines would probably be the worst case scenario, putting everybody in limbo, and as opposed to being able to get on with it after that early November election. But it's interesting as well, because we had a little joke about this overnight, that although I think we're both seeing areas where you definitely would not be stomping in with your big, let's fill the boots up kind of thing. And we are sort of definitely still, you should be running a long short portfolio and not making, going for sort of the hero trades.
Yeah.
Said that, we've actually got 3 long ideas today. So as we joked overnight, that's clearly an inverse signal for the market direction. So, I mean, on that subject, I'm just going to talk about my first idea, which is a stock called QDEL, and it does have, I apologise for this, it does have a COVID theme to it. So the ticker is QDEL. As I say, the company is called QDEL. Market cap is just under $7 billion. Share price around 161 bucks. Now, before I get onto the metrics, so the quantitative things that we're looking at in terms of P ratios, growth rates, etc., just a basic description of their business. So QDEL is essentially, they're a diagnostic testing company, and they provide diagnostic tests for detecting medical conditions and illnesses. So you've guessed it, they've got a COVID-19 test, of course. Now, the situation with this company is that, it's not a one-trick pony, so it's not just about COVID. I mean, on that subject, they received from the FDA something called an EUA, which is an expedited emergency use authorization, which I'll talk about in a bit. But just to sort of roll back a little bit and give you the overall kind of top-down view of where we are with COVID-19 testing. So just to give you an idea of the kind of scale that we might be looking at. So a recent report by Jefferies, which is a pretty large, well-known broker out there in the US, they reckon that the US still needs to increase its coronavirus testing capacity by at least 10 times. And that equates to between 400 to 500 million tests required, which is obviously enormous for this upcoming sort of COVID/flu season. Now, if that's the opportunity, then for companies sort of including people like the big guys that people would have heard of, like Abbott, Danaher, Roche, Thermo Fisher Scientific, we're talking about possibly a $16 billion revenue increase across the whole sector just for that magnitude of tests. Now, in terms of what's on offer for testing at the moment, you've basically got 2 types of test. You've got what's called PCR, and you've got what's called antibody testing, and these are currently the 2 primary ways of testing. Now, QDEL, as I said, so getting into their specific story, they in May were issued the first emergency use authorization for a COVID-19 antigen test. Now they use this system called Sophia, which they use to deliver other tests as well. But for this particular EUA from the FDA, they're using their Sophia 2 SARS antigen test, which is a rapid point of care test. So you basically get your results from this within 15 minutes, which if you put that into a European context, the issues that we're having currently in the UK, it really puts that, it really does show you how powerful that test is. So this is as opposed to a PCR test, which takes basically hours to get the results. So you're still going to have both types of testing, because the PCR test is, even though it's longer and more arduous, obviously it's slightly more detailed, but you're going to basically have that side of things, and then on the other side, the rapid antigen tests, which QDEL is doing. So the idea behind the trade here is that, as I mentioned to you earlier on, Abbott Laboratories is one of their competitors, quite a big company, and they basically have introduced at the end of August a test. This was specifically for a government contract, which costs $5. Now that compares to a price that QDEL offer in the sort of $10 to $12 region per test. So unsurprisingly, on the back of that, the stock dropped 30%. Now it had already started coming off from the top anyway. So this stock has obviously had a rapid rise this year. It hit as high as $300, started to come back, and then the Abbott news came out, and it's basically fallen down back to a low of 150, and we're currently around 161. So now this is where the opportunity comes in. So unlike the market, QDEL had been expecting and had actually been saying, for those people who are listening, that they were expecting competition, and they were specifically expecting competition from the Abbott COVID-19 test. And they actually think that because this is also an antigen test, that it actually validates even more their own testing regime. And so whilst acknowledging the low price and the scalability of Abbott's lateral flow test, they believe that $5 pricing is a one-time price for a government contract, and that it doesn't affect where they're going to be selling their tests. Now, clearly, there's going to be a two-way view on that. So they also said that they were expecting that particular contract to be priced as it was. So that's the kind of the opportunity. Now, in terms of the other factors that I would use to back up the bull case, number two, they're actually going to be launching this month a combination flu and COVID-19 test, which the benefits of that are fairly obvious. It's a combination test, and it's going to be another one of these rapid antigen tests. Now that, as I say, should be in place and out there by the end of the month. As mentioned before, point number three, I'd say they already have long-term contracts for testing of many other medical issues and conditions outside of COVID. So they've all, that revenue is not going away. Number four, they've got 50,000 of their instruments out there across the US, which is what they're using their Sophia platform across. So again, they've already got installed capacity. And, I think, in terms of like updating the sort of news flow for the company, end of August, so this is around about the same time as the Abbott announcement, you've got them increasing their stock buyback program. Now, of course, we know that everybody uses stock buybacks. That doesn't make you unique these days. But much more importantly, as I see it, the CEO has been in buying shares again. So he bought some back in June, just after the FDA announcement. He bought 5,000 shares, and he's bought another 5,000 shares on August the 31st at $175, so above where we are here, and that's about $900,000 worth of stock, in addition to the $900,000 worth of stock he bought back in June. So I tend to place greater significance on that because, as we always used to say in the old days, you want to see people with skin in the game. And it's always good to see management actually putting their money where their mouth is. Lastly, what I would say is that, since the Abbott news, not a single analyst, and this was on August the 26th, so they've had time to rerun their numbers. Not a single one has taken down their estimates. And in fact, in the last 7 days, EPS estimates are actually going up again for the company. So they've gone up 14% in the last 7 days to $12.04 for this year. That's basically 300% EPS growth for this year. And so next year, estimates have gone up as well, 16% to $16.04. That would be a 33% growth rate. Now, to put that into context with the rest of the sector, if you just bear with me. So in terms of the sector, we're talking about growth rates of 32% for this year. That's versus 300% for the company, and 30% for the rest of the sector for F2, which compares to about, as I said, 33% for QDEL. Now, this thing doesn't have the same. It doesn't have the exact sort of profile that we would normally look for in terms of the premium P ratio compared to the peer group. It does trade at a discount, but I'm arguing that that's because we've got a buying opportunity here with the stock having come back quite a long way. And lastly, in terms of trade structure, so I already own the stock around here, just slightly lower than 161. I've got a target of $200 by the end of the year, which I think is easily achievable given where the stock has been. If you think that's a little bit too risky, if you think it's a little bit of a binomial tree that you're looking at here, then of course you've got the ability to go and have a look at the options market, and maybe you want to have a look at the call spreads for around year end. Their next report is around the beginning of November. So if you look at call strategies, obviously bullish call strategies, call spreads around December time, I think maybe that's another way to play it as well. So in summary, I think that the growth story is basically still intact.
Cool. Okay. Well, you mentioned that we've got a few longs to look at today. So Ed, let's move over to you. What was your long?
Yes. Well, I'm going to have a look at Overstock OSTK, $3 billion company. Overstock is an online retailer and a technology company that operates under 3 umbrellas: retail, T0, and Medici. Now, retail is a pure play e-commerce retailer specializing in the home furnishings. T0 is a fintech company. It's developing a next generation capital market using blockchain. We're talking tokenizing assets, trading and settling using the blockchain. Basically, we're just commercializing the financial applications of blockchain. And then we have Medici. Now, they have a lofty aspiration to make the world a better place by solving big world problems with blockchain. Now, before your eyes start rolling, Wall Street assigns a zero value to T0 and Medici, but they are involved in some very interesting ventures. But we need a brief history of the stock. The company used to be run by a guy called Patrick Byrne, crazy genius, very high on vision, very low on execution. The stock tanked from $80 down to as low as about $3 by as recently as May of this year. So Byrne went and they got this guy called Jonathan Johnson in. This guy's a smart guy. He's an execution guy. So he came in at H2 2019. He immediately started to de-risk the e-commerce business. He's a technically minded guy. He's steadied the ship. And basically, the first half of 2020 shows what good execution looks like. So they got their revenue up about 109%. They got their operational expenditure down 5 points rather, to 17%. And gross margins went up to 24%. Their new customer growth was 209%. And their recurring business from their new customers was up 16%. So they're getting new customers. So what? COVID's meant all online retailers are having a good year, but we go on. The new customer growth is showing very well with their older millennials. So these brave boys and girls finally moving out of mum and dad's, they seem to be quite happy buying a lot of their nesting material online. If we take the sector as a whole, home furnishings is a $150 billion market. Prior to 2020, online penetration was going up 2% a year. So we got up to about 22% at the end of last year. Obviously, the COVID tailwind has now moved that up 12 points. So a third of all online furnishings are done online. Now remember, Overstock is a specialist. It's a one silo business in home furnishings. They use a lot of AI and machine learning. They've got a very, very efficient, scalable operation, and they're now just starting to move into other subsectors of retail. Stock rallied as high as 125. So you might say, why now? Why Overstock now? We've seen a bit of negativity on the street. People are naturally saying that the explosive sales growth online is starting to slow down. There's a bit of ISM weak data coming out in furniture production. That's just shown as the first signs of contracting. But I'd say this, Overstock is operating in a fantastic segment of this market. It's the fifth most recognized brand. So you have Walmart, Target, and Amazon, but they're obviously generalist retailers in the space. Then you've got Wayfair, that's obviously at the high end. And then you have Overstock, the only specialist retailer who's operating in the value part of the market. So why now? Well, the stock was trading, it went from $3 to $125. And then we had the allegedly SoftBank options action, led to a nice bit of gamma hammer in the market. We saw a lot of profit taking in the frothy names, on top of a bit of negativity about potential sales growth deceleration. And the stock came all the way back down to the early 60s. I've been watching this for a while. I thought I'd missed it and certainly wasn't going to chase it. But all of a sudden, we got an opportunity in the low to mid 60s. So we started buying a position. Now, you can argue that price action is a bit uncomfortable, which it is. You can argue that how can something go down 50% and still be, good? What is the true valuation? Well, I think retail sales in this sector are going to hold up well. I think Overstock's got the best, most efficient, scalable model, and I think they're in the right part of the market. So clearly, the entry point here is the opportunity. The story was the same a month ago. The price isn't the same this month, and I think it's a great opportunity. What I also like about Overstock is the crazy part of the business. So I have to talk about those briefly. Remember, you're getting these for nothing. Zero value, probably a slightly negative value, because they still take a bit of capital from the parent retail business. So T0, alternative tokens. What's a token? Anything that's not a conventional securitized asset with a revenue stream. So they've basically built a blockchain-based token superhighway, or a motorway if you're from England. How many cars or tokens are on this superhighway? 2. I'll say it again. There are 2 tokens that you can trade on their platform. What are they? Well, they're the Overstock dividend. They've tokenized their dividend. And the St. Regis Luxury Hotel in Aspen has tokenized an asset. What can you tokenize? Anything with a revenue stream. Where are all these new tokens going to come from? Well, they have 105 relationships with private companies and real estate companies, and they'll be working very hard to try and get a landmark deal over the line. Why would private companies use tokens rather a securities listing or a fixed income raising? Well, they can access a potentially new, more retail-based investor base. They don't have to go through the brouhaha and expense of a full investment banking raising. And that's really it. Now, there's another potentially very exciting part of this, and that's really the royalties side. What does that mean? Well, music artists can tokenize their royalties. Professional athletes can tokenize their endorsements. You could tokenize the college draft. Now, remember, all of this sounds stupid until it isn't. We live in a market, people see, people do world. Think of sports betting. Think of that sector of the American population who's knowledgeable. They love betting on sports. They understand sports. It would be fun to trade the draft. These are things that could really become viable. When will they become viable? Next month? Don't know. Next year? Who knows? Doesn't really matter. But I believe tokens are coming. You can look at a venerable institution like Fidelity. They've got a smart guy building out a very large digital securitized business. So that's that. What do they make at the moment? This year, $23 million. They'll make their money by capital formation if they can get some deals over the line. So that's just money raising. Then you're trading the tokens for commission. You're licensing your technology out. They've got patents upwards, downwards, and sideways, and they offer engineering support. But that's basically the business. There are 2 tokens. There's no sign of an imminent flurry, but when it comes, it can come quite quickly, and you can re-rate this stock without that much happening, in my opinion. When you look at Medici, this is obviously just pure blockchain. What does that really mean? Well, what they do is they partner up with companies who think they've got a solution to a big world problem. So they have a relationship with a company called Voatz, V-O-A-T-Z. What are we talking about here? We're talking about digital remote voting platform. It's actually compliant with the federal voting system. Obviously, voting is a topical situation. We've got problems with polling stations, mail fraud, all that stuff. We do all our banking on our phone. You know, with a triple encryption, there's no reason why you can't be voting off your mobile. Is this happening tomorrow? No. Is there value in this sort of business venture? Not at the moment. But it's not hard to see that it could become valuable. This could be a valuable enterprise. You can tokenize that value. You can trade it, and all of a sudden you're in that sort of cycle. They've got loads of these, tens of these partnerships. They're dealing with issues such as medical records. Why blockchain? Why do we care? Well, it's security and accessibility. They're looking at third world land titling rights. That's more of a problem in the developing world. Is that commercial now? No. Could it happen? Yes. And I think it's a bit like having a few more tokens. Once there is a good blockchain, purely blockchain driven solution to current issues, I think again, the spotlight gets shined on, people suddenly are interested, and remember, you're buying these 2 crazy businesses for nothing. So what do you really get when you buy Overstock today? In my opinion, you're buying a reasonable valuation. Sorry, I haven't really touched on that. I mean, Overstock's trading at 1.4 enterprise value to sales. Wayfair trades on 2.1 times. Does that make Overstock cheap? Don't know. It's cheaper than Wayfair. I think it's in the right segment. I think their earnings growth is more sustainable, and I think their platform is scalable. And Johnson & Johnson is an execution guy. Are they going to invest loads of capital in these businesses? No. Are they more likely to partner? Yes. If tokens become a thing, you could easily see a deal coming between T0 and an alternative, Wall Street firm with a big client base who are more interested potentially in the token market. I think he'll partner up. I don't think he's going to take his eye off the ball. Their bread and butter is driving this efficient operation and scaling that up. So I'll leave it there. In terms of trading it, we've got earnings on 10th of November. You can trade, I traded an October call spread, so $70 to $95. So it gives you about $17 of upside if the stock retraces 50%. Time horizon's quite short. If that works, then we'll reinvest. I want to stay long November earnings. And then obviously it's just a fun trade with a free option. It's going to be volatile. And so there should be some good trading opportunities. If it's not for you, then keep it on your watch list. Oh, one last point, anecdotally. It came out last week and said it had become a broker-dealer on the platform. Stock rallied 25%. Absurd. It's a broker. They're a broker-dealer on the token superhighway with 2 tokens on, and there were only 2 other broker-dealers on it. The stock came back down before it started rallying again. That sort of price action is not actually very comfortable. It's not that encouraging. But what it does highlight is that any signs of progress in any of these 2 businesses, the market wants to believe and it wants to take the stock higher. So you're buying it today because it's a quality business. I think earnings will surprise. I think earnings growth will be stickier. You're getting it at the best valuation you've had for a long time, and you're getting two crazy businesses thrown in for free.
Great stuff. It sounds like as well with things related to blockchain, it's almost like you kind of described if one domino falls, many could, and it could get really interesting. Jason, let's go back to you for your last one.
Yeah, that was very interesting, Shecky, and also great use of the word brouhaha. Did somebody have a wager with you that you couldn't get back?
I realised I hadn't used that word for probably decades, actually, so I thought it was time to get it back out there.
I think maybe we're from a similar generation, so we used to use that word. Yeah, the last stock I'm going to talk about is another long idea. So the company's called Elastic, tickers ESTC, market cap just shy of $9 billion. Share price currently around $103. So very briefly, what do they do? So they've basically got a software analytics engine that specializes in big data search capabilities. We'll talk a bit later on very briefly about what big data is. So it's a cloud business model. I've heard some people, clearly bulls, refer to them as the little Google of big data. Not sure about that, but certainly, they've got a very sort of significant presence in this market. So for anyone out there that follows this industry, their products are things like the Elastic Stack, Elasticsearch, Kibana, Beats, Logstash. They describe themselves in this way: from stock quotes to Twitter streams, Apache logs to WordPress blogs, we help people explore and analyze their data differently using the power of search. Now, it sounds, fairly grandiose, but they have a unique take on essentially searching through big data is basically the summary. Now, in terms of, currently the company has got sales around $750 million. Now, this is, I'll say from the outset, this is a sales stroke, it's a revenue growth story here that we're looking at. It's not about P ratios, because they're actually loss making, as are most of their competitors. It's not about therefore P ratios or earnings growth rates. It's about sales growth. And for this company, we're looking at consistent 28% sales growth this year and for next year as well. So F1 and F2 sales growth up there, towards 30%. Now, in terms of their total addressable market, they think it's in the tens of billions of dollars. As I said, just a little bit of background on, what big data is. So essentially, if you think about all the information that's being, collated about us by companies through, various sources, through, communication networks, the internet of things, streaming, all that stuff. Basically, obviously, that just creates an enormous amount of bits and bytes up there in the cloud, and clearly over time, the cost effectiveness of storing all that stuff is coming down and down and down, which means that they can work on much bigger parcels of data here. So the smart guys out there, basically, they've learned, how to mine and model what is essentially a kind of a data deluge. And the competitive advantage here is obviously to learn quickly about companies, customers, products, supply chains, and where they can innovate. There's something that came up that Splunk, which is one of Elastic's competitors, mentioned in the past year, that they refer to as dark data, and that's what they're referring to is basically loads of files being deposited on servers all the time in log files, and that without the right mining tools, you literally can't get access to that data, and that's another unexplored area that these guys and Elastic are able to open up. So in terms of the peer group with respect to Elastic, you're talking about Splunk, Alteryx, which is one I think that has been mentioned certainly around the Institute before, Datadog, and another company called MongoDB. In terms of valuation, these things, as I say, they're revenue growth stories. So this thing, we look at it in terms of a multiple of sales, of revenues. So this company trades at 12 times sales. The competition, many of the software stocks out there are trading around 25 times, albeit for growth that looks that is certainly even larger or of greater magnitude. But the question, I think, is is that growth sustainable? I think that, as I say, with Elastic, they've got quite unique big data capability in terms of searching, and we are according to the street, we're looking at steady 28% revenue growth this year and next year. Just to put that into context, the most bullish guy on the street is Citigroup. They think that the company, which is part of my argument for actually getting into it, is performing the age-old trick of underperforming to over-deliver, and he thinks that you could actually see revenue growth in the mid to high 40%. So obviously much significantly higher. In terms of the last earnings report, which was on August the 26th, so this was their Q1. They've got a bit of an odd financial year. The summary is it was a strong beat and raise quarter, which means that so for their Q1 of 2021, which is what they reported, they actually reported a small profit of 6 cents. Now that's come a lot earlier than people were expecting. Consensus was actually looking for a loss of 18 cents. Now, I don't think the company is about to become consistently profitable, but that's obviously still a nice surprise. And they beat on revenues as well. So Q1 revenue consensus was 121 million. They came in with 129 million. So that's a good 6.5–7% beat. And that was on the back of a massive beat in Q4. So that was the previous quarter for them of their financial year 2020, which was a 60% beat on the earnings side of things. As I say, we're still not expecting them to be profitable across the whole of the year. It's a very much a revenue growth story. In terms of the guidance, so this was the sort of hat trick that they had. They actually raised their 2021 earnings and revenue guidance. So they took the range in terms of 2021, which is their current year. They're in their fiscal 2021. They've taken their loss range from negative 98 cents to negative 85 cents. That's the previous range, to the new range of negative 83 cents to negative 69 cents. So that's quite a large upgrade. And they've taken the revenue outlook for this year, originally around 540. So that's $540 million. They've taken that now to a range of 544 to 550. Again, I think they're under-egging it. They've got a history of basically exceeding, as they did in this last quarterly report, expectations on revenue growth, billings, and margins. And I think that we're going to see the same thing in Q2. Now, there is a potential risk here, which they have mentioned, because obviously nothing comes for free. They are looking at a slightly longer sales cycle, they say, which is what you might expect, given the background for this year. But they are still seeing continued recovery in business activity and strong customer metrics, as they put it. Now, looking at the chart, it's basically, we don't like to talk too much about TA, so I'll be pretty brief on this. It's basically found support with a couple of its shorter term moving averages. So like a lot of companies in this space, they obviously had some profit taking off the top. It came back, maybe not as much as I'd like it to, but it's come back to support levels on the 50-day moving average and the 20-day. It's, as I say, it's around 103. I think that you're looking at a target price of 125 by the year end. I've started to build a stock position here, but I think again, as with the first idea that I mentioned, you probably want to look at December call strategies as well, because that will also take into that time frame. their next quarterly report, which is at the beginning of December. So that is one where it's not looking, as we say, like a solid green light from a chart perspective, but it's definitely somewhere between green and amber. And so I think that you basically start to scale into a position at these levels, looking for, you know, a 20-25% return on it. Just, you know, from an equity perspective, you can obviously generate more from that from looking at the core strategies. And this is, you know, with a time frame sort of from now until year end.
Cool. All right, gents. Well, 3 potential long ideas on that episode. As you guys discussed earlier, that probably means we're calling the market top as well.
Exactly. Just in the industry that NVIDIA may have done that.
Yeah. But seriously, it's been a great episode. We've talked stocks with interest in big data, in COVID vaccines, blockchain, all super high growth potential industries. So I appreciate you guys coming on and talking about those. As always, for you guys watching, the point of this series really is to give you guys an insight into what it takes to generate ideas and build a successful portfolio. If you then want to go to the stage where you want to learn more about doing that yourselves, then you can do so by visiting our website, itpm.com. You can start out by checking out our events that we've got coming up, sign up to those. You can get the educational courses, you can get mentoring with these guys, Jason, Ed, and the other mentors that you see on What's on Your Mind as well. And all of that will put you well on your way to then progressing and successfully managing your own portfolio as well. So I'll put links to that below the video. But that's all from us this week. I hope you guys enjoyed it, and make sure you join us next time for another episode of What's on Your Mind.